What connects the following things with today? Anyone recognise that gentleman on the left? It's Maradona's first World Cup, the release of E.T., the invention of the CD. Since the CD was invented, over 300 billion have been sold worldwide. Michael Jackson released his Thriller album. Does anyone recognise that little boy? It is, of course, Prince William. And Time, for the first time, named their Man of the Year as the computer. First time they didn't name it as an individual. Of course, all of these things happened in 1982. And 1982 was the last time in the US that we saw inflation running at 7.9%. 7.9%. Of course, there is a very noticeable difference between then and now, and that is what the cash rates in various countries are doing. Back then, the federal funds rate was 15%. In Australia, the RBA cash rate was in the high 20s. We sit here today barely off zero in both of those economies. And so obviously it's raising some questions in the market, and that's what we're here to understand today. So we're going to run through what are central banks seeing and why are they responding the way they're responding, why are markets reacting to that, and then importantly, does it portend some sort of negative shock for the domestic economy? And you'll see that our answer to that question is firmly no. We're going to look at the conflict in Ukraine and how that's affecting economies around the world, and we'll conclude with how we're positioned in a few stocks that we've been adding to recently. Just as a brief overview, Auscap is an active manager. We look absolutely nothing like the index. We own one stock in the top 20. That's Macquarie Group. We've owned them for a very, very long period of time. But our sweet spot is really that mid and large cap space between the ASX 20 and the ASX 120 to 130. We are a value manager. Our timing wasn't great. We launched Auscap 9.5 years ago, about 3 months after value peaked against growth last cycle. So it's been a somewhat interesting environment, but we'd like to think that we've delivered some decent returns for our investors despite the headwind of our investment style. We have a very, very strong focus on high quality businesses. We want to buy best of breed. Somewhere along the way, value got confused with buying low quality stocks. That's not what we do. We like buying best of breed stocks, but we're very mindful of the price that we pay for those stocks. We have a strong preference for market leaders, for those that are run by founders or majority shareholders, and those that are in a very, very conservative position from a balance sheet perspective. The end result of that is we've managed to deliver over 700 basis points of alpha net to our investors over the last 9.5 years. And along the way, we actually made a change that was favourable to our investor base. On the 1st of January 2021, we changed our performance fee hurdle from the cash rate, which has copped some fair criticism given its average 1.4% since we started, to the All Ords Accumulation Index, while also keeping the cash rate as a secondary hurdle. So we'll never take a performance fee when our returns are negative in absolute terms, but it would have had the effect of boosting our inception net number to over 18% over the last 9.5 years. So how have we delivered this? In the context of it being a very, very difficult environment for value investors. And the answer is fairly simple. We buy businesses where we think they are going to successfully compound their returns and their earnings at attractive rates over time. And it's been earnings growth that has driven that performance. So let's get into some of the things that are on people's minds today. And the first is, what are the economic indicators that central banks are looking at, and why are they acting the way they're acting? And we've got to take a little bit of a step back to go to pre-COVID. And if you can see, we came out of the GFC, growth peaked about 2012, and then between 2012 and 2020, inflation was remarkably benign. Most developed economies struggle to get inflation within their target band. And there's a very good reason for that. Wage growth is critical in the developed world for seeing inflation that's consistently in the band. We live in service-led economies. If you're not seeing wage growth above the target band, you're not going to see inflation persistently within the band. And over that entire period, it didn't matter what central banks did. It didn't matter how low they took their cash rate, we couldn't generate a sufficient level of wage growth to see inflation in their target band. And as a result, if you just focus on Australia, which is the green and gold line with and without bonuses, you can see that wage growth's been on this one-way trajectory over that period post-GFC. And as a result, it very clearly replicates what the RBA cash rate's done, top left to bottom right. Central bank haven't been able to get the economy in a position of full employment where we've seen sufficient wage growth to see inflation in their target band. So what changed? Well, all of a sudden COVID hit, everyone assumed it would be deflationary, but then all of a sudden there were these inflationary forces, not least of which was all of the stimulus handed out by governments to individuals and households around the world. It was a very unusual recession in most developed countries. Why? We had a recession and yet average wages increased at their fastest rate in some time. Right? And that was all of the stimulus that was handed somewhat indiscriminately, but sensibly out to households. The second part of that is we obviously were all stuck at home. We're all demanding the same sorts of goods and services while we're at home. And you combine that with supply chain issues from rolling lockdowns, and we saw the price of goods go up as the availability declined. And the end result of that is we saw a sharp takeoff in inflation. Now, of course, central banks looked at all of these things and they said, well, the stimulus is transitory, the supply chain issues are transitory, these things should roll over. So in the last 12 months, why have they changed their tune? They've changed their tune because they weren't expecting wage growth to persist. The red and the blue lines are wage growth in the UK and the US. And you can see that despite the fact that we're well through cycling the stimulus period, we're still seeing wage growth run in that 4 to 6% band. And as a result, their conclusion is that inflation is likely to be less transitory and more potentially permanent than they had anticipated. It also explains why the Bank of England and the Federal Reserve are in a reasonably different position to the RBA. If you have a look at where their wage growth's running, there is an immediate need for them to start lifting interest rates, which is exactly what they're doing. Australia, by contrast, still only has wage growth running at 2.3% and inflation running at 2.6% on an underlying basis. And as a result, our glide path at the moment looks quite different to the Federal Reserve or the Bank of England. And of course, markets are responding to this. They responded on the way down and they're going to respond on the way back up. We went into COVID and everyone automatically assumed that the result of COVID would be a decade of low growth. So the blue line here is the US 10-year yield, and what it implies is that when COVID hit, we were going to be in a lower growth, possibly deflationary environment, lower interest rate environment for a decade, right? Within a year, that outlook had changed quite markedly, and now we're seeing the opposite effect. The question is, why is that important for markets? And the answer is fairly simple. At the end of the day, the US 10-year is the closest proxy the world has to the risk-free rate. So if you move the risk-free rate lower, then you reprice all other assets higher, whether it's residential property, commercial property, or equities. And that's exactly what we saw. If you look at the US market, the yellow line here is the price to earnings multiple on the S&P 500, and we go back to 2012. If you look at the period prior to the impact of COVID, it averaged about 15.7 times. And then all of a sudden we see COVID hit, we see the US 10-year, which is inverted, it's the blue line here, so the US 10-year yield drops, and after the initial sell-off, assets reprice. The market moves into the low 20s from a PE basis. And that's quite logical. You've taken down the risk-free rate, discount rates have compressed, that makes all other assets worth more than they previously were. Right now we're seeing the unwinding of that, also somewhat logical. This sell-off reminds us of the 2007 to 2009 sell-off, the 2000 to 2003 sell-off. It's very different from the exogenous shock that was COVID, right? And so what we're seeing at the moment we think is fairly logical, and you can see that the current PE on the S&P 500 is still well above where it traded for much of the last decade. You also saw that within Australia. So again, average PE over the 8 years prior to COVID of 14.9 times, all of a sudden COVID hits and equities reprice higher. Now, of course, not all equities repriced in the same manner, and there's a very good reason for this. A lot of the companies that were cyclically exposed, think the banks, the miners, the retailers, those sorts of businesses, if we were going into a lower growth environment, they were going to have lower revenue growth and lower earnings growth. So there were two effects. You had lower revenue and earnings growth and a lower discount rate. And the net outcome of those two things was actually a lower valuation. By contrast, all of those stocks and sectors that were viewed as having growth that was independent of the cycle saw no impact on their revenue and earnings growth, but a substantially lower discount rate. And the end result of that outcome was significantly higher prices. And you can see that in the performance of different indices. The green line here is the US index, right? It's chock full of technology companies and healthcare companies, and it re-rated very, very significantly. You contrast that with the yellow line. The yellow line is the Ftse 100. The Ftse 100 is chock full of miners, banks, retailers, property developers, a whole bunch of cyclical companies. It didn't reprice at all. You can see it within the Australian market if we think about which sectors look like they have growth that's independent of broad GDP growth. And we would identify healthcare, infrastructure, the offshore earners, so those companies expanding into new geographies, technology companies, and staples as being industries that looked like they have growth that was completely independent of what was going on in the broader economy. And so down the bottom we have a bunch of bellwether stocks in the ASX 200 according to those different sectors, whether it's CSL, Transurban, Breville, Real Estate, Technology One or Woolworths. I'm going to spend a little bit of time explaining this chart. The first bar, the light blue line, is the average PE that stock traded on between 2012 and 2015, the first 4 years of the fund's existence. The dark blue line is the PE of that stock last Friday, right? 6 months after a lot of these stocks started selling off, right? And you can see via the yellow dot, which refers to the right-hand axis, the percentage change in the PE from then to now. And that's a monstrous index. The second bottom line there is 100%. So if you see a yellow dot at 100%, that means the multiple as of last Friday was double the average multiple that stock traded on between 2012 and 2015. In many cases, I think you could mount a strong argument that the growth outlook for some of these businesses, for many of these businesses, was strong in the former period than it is today. So we saw a very, very significant repricing in those companies that looked like they had growth that had nothing to do with what was happening in the broader economy. And the converse is also true. If we go to those cyclical sectors that I discussed, the banks, the miners, the retailers, the property trusts, here we have the big four banks, the big three miners, a bunch of discretionary names that have been around for a very long time, a bunch of the property trusts. And you can see that quite a lot of them, even today, are trading on a significantly lower multiple than the multiple they traded on back between 2012 and 2015. With the banks probably being the one exception, and that was a function of the control time period. Between 2012 and 2015, we were experiencing a range of rolling sovereign debt crises, and the end result of that was banks globally traded at somewhat depressed multiples. And again, if you look at the left-hand axis, it's not like the PEs then or now are particularly onerous, and you can contrast that with the PE range that I've got on this screen. At the top of that is 100 times, so to the extent that you see a current bar off the top end of that, the stock is trading on more than 100 times current earnings. So the big question that a lot of people want to ask in relation to the sell-off of the last couple of months is, does it portend some sort of doom for the domestic economy? And our firm answer is no. Actually, the RBA has recently updated its guidance around expected GDP. They now expect GDP to be above where it would have been on trend if we'd never seen COVID in the first place. That is somewhat extraordinary. Unemployment just printed the third lowest print in history since we started recording monthly data back in 1974. The only two prints that were lower were back in 2007, and yet, somewhat strangely, Australia is experiencing the highest participation rate on record. There are more people employed as a percentage of the population today than ever before. And economists can't really explain this. In the US and the UK, you've seen the Great Resignation. Millions of people have fallen out of the workforce. That's not been the case in Australia. And the end result of this is there are more people employed today than we've ever seen before. And you can see that the yellow line is the absolute number of people employed, and the blue line is somewhat extraordinary. That is job vacancies. The last data print that we've got on the quarterly ABS data that we received was November, and at that point in time, there were 70% more jobs available than the record pre-COVID number. 70%. And trust me, it's not because we're missing out on the fruit pickers or the tourists to work in the pubs. And we know that because we can track every single industry. Every single industry has more jobs available today than they did in November 2019. So the outlook for the employment market is very strong. We expect the unemployment rate to trend into the mid-threes in the immediate future. It's very, very positive, and as a result, you're starting to see an impact on wage growth. You can see that private sector wage growth, which is the blue line, has picked up off its COVID lows. We expect to see that continue to accelerate. Why aren't we seeing it accelerate at the same rate as the UK or the US? Well, the answer to that is fairly simple. Their jobs market is a little tighter than ours. They've got unemployment running in the mid-threes, but there's also a structural element to it. Quite a lot of Australians are employed under enterprise bargaining agreements. The vast majority of those stretch from 2 to 5 years. And so we tend to find that wage growth in this country is sticky on the way down and it's sticky on the way up. We have absolutely no doubt that these lines are going to trend up over the next couple of years. Household savings over the last couple of years have been phenomenal. Households and small businesses, we estimate, have saved $450 billion over the last 2 years. The normal run rate over that 2-year period would be 80 to 100, 40 to 50 billion a year. So they've saved 5x what they normally save. The biggest misnomer in markets is we've had this great stimulus and then we've got to cycle it. There's got to be a come down from the stimulus that we saw. Actually, nothing could be further from the truth. The stimulus wasn't spent. This wasn't the 2009 school building revolution or pink bats. This was handouts to individuals. Individuals collected the $200 billion, they put it in their bank account, and then on top of that, they saved another $250 billion and stuck that on top. That stimulus is going to come out over, we suspect, the next decade. And as a result, household leverage has actually declined. It's very unusual to see interest rates fall and household leverage fall alongside it. But if you look at net leverage, which is the yellow line, net leverage is back to 2002 levels. The last time net leverage at the household level was this low, the cash rate was at 5%, heading to over 7%. We're in a very, very different position today. So it should be no surprise to see property prices move north. As we see a moderation in interest rates, this will level off. Household wealth's also been very strong. That's a function of property prices, equity markets, and the accumulated savings that we talked about. Housing finance is a little bit extended at the moment, but it's coming off a relatively low base because remember we went through that housing downturn from 2017 to 2019. So we were well below trend at that point in time. The bigger question to ask is how much problematic lending is being done. And the answer is surprisingly little. Surprisingly little. The blue line here is the amount of lending that's being done, new lending, with an LVR of greater than or equal to 90%. And you can see even without adjusting for APRA's methodology change in 2018, which captured a whole lot of additional people and put them in that bucket, we are printing remarkably low levels at the moment. The one area of concern that the RBA and APRA do have is the percentage of people that are borrowing more than 6 times their gross household income, and we know that APRA's instructed the banks to get that number lower over time. So we suspect that that will roll in the immediate future, and we do know that it's also indicating in the data that those with the highest incomes are the ones borrowing the most. They're also the ones most likely to see above average wage growth going forward. So at this point in time, we don't see that as a problem. The end result of that is the household interest payments as a percentage of income has never been this low. It's never been below 6% before. It's telling you that households are in a remarkably good position. And that's what we continue to see in the retail sales data. These charts are a little bit complicated, but the purple line here is the 2021 spending. The red dot is January 2022. And so we're just going to spend a moment on that red dot, because it's somewhat remarkable that given the emergence of Omicron in about a week out from the start of the new year, that January in every state printed a new record. In fact, at a national level, January retail sales were up 5.8% on the prior year. And yet we know quite a lot of companies through reporting season identified that foot traffic fell very considerably. Nick Scully reported that their foot traffic was down 25%. When you see a surprisingly good number in what you expect to be a weak environment, you want to pay attention, right? We just yesterday got the February print. The February print is up 9.1%. Now we're hearing that most retailers thought February was patchy and that March is going exceptionally. If patchy is up 9.1% on what was already a record, it's going to be interesting to see the March print. And the reason for this strength, households are in a very, very good position. And that's before we get to terms of trade, it's before we get to the fact that we're seeing record soft commodity prices, record hard commodity prices, and record volumes. You combine those three things with a relatively low currency, and our terms of trade in the next couple of quarters are going to print some remarkable numbers. So the outlook for the domestic economy is very, very strong. What about the conflict in the Ukraine? Well, actually, in global terms, Russia's not that significant. At 1.8% of global GDP, it's not that far ahead of Australia. In fact, it's probably a wonderful advertisement for democracy. Given they have nearly 6 times the population and both countries are endowed with a lot of natural resources, the fact that they're only a smidge ahead of us is probably telling. In terms of exports, obviously the key export for them is petroleum-related products. In this regard, and obviously our sympathies extend to all of the people that are innocently affected by what is a humanitarian crisis, but purely from an economic perspective, it reminds us a little bit of what happened between China and Australia about a year ago. China refused to accept a lot of our imports with one exception. Iron ore never got touched. The reason iron ore didn't get touched was they couldn't find it from anywhere else. No one can replace Australia in the iron ore chain. So they could stop accepting our coal and our wheat and our lobsters and our wine, but at the end of the day, the critical resource didn't get touched. It's very, very similar to Europe and what's going on in terms of natural gas and petroleum products. Again, they're very, very reliant for their energy needs, so it's the one area that hasn't been touched. What we saw in the Australia-China case was actually the rest of the trade got rerouted remarkably quickly. In fact, everyone was surprised at just how quickly that happened. But it shouldn't be a surprise, because at the end of the day, demand and supply have not changed. So when China says we're not buying your wheat, they've got to go and get it from somewhere else. Well, somewhere else was supplying another couple of countries. And so they then say, well, hang on, we need someone else's wheat, and Australia fills that void. We all incur a little more in transportation costs, but the rerouting happens pretty quickly. We can't say that about the Ukraine because we know production is being impacted quite significantly. And actually, the Ukraine is a reasonably large component of their top 20 exports. They're a big country, they're a big producer. You can see that in terms of their percentage of just their top 5 exports. But their percentages are reasonably similar if I extended that to their top 20. In that regard, unfortunately, Australia is a bit of a beneficiary, because actually we export a lot of the things that they export, and as a result we're seeing higher prices at a time when Australia is producing record crops. So if we take all of that as a given, what to buy and when, well, you are getting paid to own equities at the moment. In a relative sense, the spread between the ASX 200 dividend yield and the RBA cash rate, which is the blue line, has only been higher briefly during the initial panic of COVID. So while we expect the cash rate to move higher, there is a very, very significant risk premium that is embedded into equity markets at the moment. For those of you waiting for value to turn against growth, we suspect you have the preconditions in place for that to take place. So what companies have we been buying? We held about 10 or 11% cash going into this significant sell-off. We've deployed most of that at the end of February and the start of March. One of the companies that we've added to is Macquarie Group. These days, Macquarie is dominated by annuity-style businesses. They're well diversified by country, and they have a reasonably incredible track record against their peer group from a return on equity perspective. So when you are trying to grow into new businesses, having this sort of return on equity leads to very, very attractive compound returns. And you can see Macquarie against some of their domestic cohort, some against some of their international cohort, their 5-year ROE and their 10-year ROE are somewhat exceptional. And that results in earnings growth. The blue lines here are EPS over time. So again, it comes back to, if you look through the companies that we've owned over the last decade, you will see that there is something reasonably common. They have all exhibited, or by and large exhibited, very strong EPS growth. And if you get strong EPS growth, you don't need the multiple to change. I remember buying JB Hi-Fi on 12.5 times when its earnings were 1/10 of the earnings today. It's still trading on 12.5 times, and it's still one of the best run retailers in the country. The same goes for Macquarie Group. If you contrast that with the large banks who haven't grown their earnings at all over the last decade, there's a very strong reason why we want to own a business like this. We've been buying an additional stake into Mineral Resources. It's been in our portfolio for a very, very long period of time. They run 3 businesses, a mining services business. They're actually the world's largest crushing contractor. They do work for all of the majors in the Pilbara. They've also got a lithium business. We're going to spend a little bit of time talking about that. They're the world's 5th largest owner of lithium assets globally, and it's the sort of lithium you want to own. It's hard rock deposits. This is what the battery makers want to see, right? So it's the type of mineral you want to own. And then they're also Australia's 5th largest iron ore producer, and at the moment they're working on moving down the cost curve in their iron ore business. Their mining services business is unusual for one feature, and that is the contract length, which is the left-hand side. It's unusual for a mining contractor to have so many contracts that have more than 5 years in duration on them, right? That's a long-term commitment from that organisation, and one that you only get if you have built up a reputation as the best contractor in the space over the previous decades. Their lithium business excites us quite considerably. At the moment, their plans are to ultimately develop a capacity for 100,000 tonnes of lithium hydroxide per annum. At spot prices, that would make them many billions of dollars a year pre-tax. This is a company that has a market cap of $8 billion. Why are we excited by lithium? Well, it's not just the price, but the price is telling you what's going on in the demand market. Demand is growing exponentially, and lithium is an absolutely critical component to the green energy transition that we're going through. Most people don't realise just how dominant Australia is in the lithium market. Australia produces more than 50% of the world's supply. So most people think it's dominated by China or by Chile or by some of the other South American countries. Not so. Australia is by far and away the largest producer of lithium, and these guys own some of the best deposits in the country. And we are seeing explosive growth in electric vehicle demand. That blue line there is cumulative sales over 2021. That contrasts with the yellow line, which is 2020, and we know this is going to keep going. And the reason we know it's going to keep going is because electric vehicle pricing is approaching parity with internal combustion engines. And when you get to that point, there is not a single reason in the world to ever buy an internal combustion again. These things are cheaper to run, they're more efficient, they have already the same, if not better, range, right, before you need to recharge as opposed to fill up for your car. They're quieter, and obviously they're environmentally friendly. Australia should be a powerhouse in the green energy move, the green energy transition. I think the biggest change we're going to see in geopolitics over the next couple of decades is the switch of power away from the Middle East and those other hydrocarbon producers towards those countries that are dominant in the green energy space. And Australia, as The Economist pointed out only last weekend, is in probably the best position to take advantage of that. Why is lithium such an important element? For those of you that remember your Year 8 periodic table, it's the 3rd element in the periodic table. It's the lightest non-gas element. Hydrogen, helium, lithium. And when we're talking about things like batteries, weight is as important as conductivity. And so virtually all of the batteries that we're seeing produced and integrated into pretty complex supply chains for OEMs around the world involve a lithium-based battery. So we can say with some certainty that demand is going to be explosive, and it's interesting that Albemarle, the world's largest lithium producer, every year for what seems now like the last 3, 4, 5 years, has upgraded their expectations for global demand and has decreased their expectations for global supply. It's proving a lot harder than people had anticipated to bring lithium online. So the outlook is very, very good. It reminds us of iron ore in the early days. Some people in the room might remember this, but back in 2005, the last year of contract pricing, the Japanese were up in arms when Nippon signed a deal with Rio to increase iron ore prices by 71.5%. It was the last year of contract pricing. After that, we went to spot pricing. They probably wish that we'd stayed on contract pricing, because today iron ore prices are up another 140% from that point in time. So why did we need to have such significant step changes in the price of iron ore? Well, demand was explosive out of China, and prior to 2005, the idea that you would develop an iron ore mine with a grade of less than 62% was unheard of. Demand was so strong, though, we actually needed to encourage mines of a lower grade to come into the market. So when Fortescue proposed mining 57%, 58% material, most people initially thought that's not going to be profitable. But at the end of the day, demand dictates everything. And at that point in time, you needed the price to move so far that projects like that would bring sufficient supply into the market to cater for demand. We are seeing the same thing with lithium. The market looks out of balance and undersupplied for the next decade. Australia should be at the forefront of filling that void, and we think Min is probably the best placed company to do that, largely because they have experience in actually bringing mines into action. They're actually a mining services company at heart, and so we're very, very excited by what we see here. They're also moving down the cost curve and increasing their production of iron ore. Again, that should move them into the lowest quartile from a cost curve perspective. It is important to remember in relation to iron ore, we don't own BHP, we don't own Rio, we don't own Fortescue, right? It's important to remember that the steel game is dominated by China. And until you see a chart like this, it's difficult to understand just how much that is the case. This is what China consuming 55% of the world's steel looks like, right? We've managed to drop some names there because I think of the spacing, but the second country there is India. India is second at 100.1 million tonnes. China at 1,080 million tonnes. It doesn't matter what happens to India in the short term. It doesn't matter whether the US, which is the fourth line, launched the largest infrastructure package you've ever seen, right? They're a rounding error on what happens to China's steel production. So when we hear, as we are at the moment, that Tier 3 and Tier 4 cities are seeing property prices down 20 to 40%, when we hear that a lot of developers that are stretched from a leverage perspective are being told to finish their existing projects but they're not going to launch any new ones, we're a little bit cautious about the outlook for steel and therefore the outlook for iron ore. Luckily, iron ore makes up less than 5% of our valuation for mineral resources. And the last thing I'll say is, for a contractor to have this sort of track record in terms of return on equity since listing, they've averaged just under 30% ROE, is reasonably extraordinary. Let's move on to probably my favourite stock at the moment, Scully. They are someone that we are all familiar with. They produce high quality furniture at attractive prices. Most people thought that everyone ran out and bought a couch during COVID, so I get an opportunity to test that thesis right here. Put your hand up if you have bought a couch in the last couple of years. Keep your hand up if you didn't move home. Okay, we have about 7 or 8 hands up, right? And I think there's probably a couple of hundred people in this room, right? That thesis is far from the truth. In fact, in 2021, the increase on the number of couches purchased on the FY20 year was only 7%. 7%. And you can see this when we look at the data. Actually, because of the housing slump, we were well below trend in terms of furniture consumption going into COVID. We've seen an acceleration and then a moderation in that, but we're only back to trend line support. It does explain, though, why the company is trading on a PE of 12 for a company of this quality. Why do I say they're high quality? Because they've had an average ROE over the last decade that exceeds 50%. 50. They're the only company we're aware of in the ASX that is in that position. Their ROE is considerably higher than dominant businesses like REA. It's somewhat extraordinary that a company can go and invest an additional $100 in an asset and earn $50 of NPAT off that asset from that point on. Right? That's what these guys have done, and what's more remarkable is they've done it ungeared for their life as a listed company. They've ended every financial year in a strong net cash position. Most people, again, think that furniture is going to decline, but what we saw in January counters that argument, because January furniture sales were a record in every state, and that was entirely unexpected. But we're most excited about the company's specific features. They have a lot of growth options, and what you really want in an investment is a company trading at a remarkably attractive price. On our numbers, this stock's on a PE of less than 10 times next year's earnings, with lots of opportunities for expansion and a very high rate of return when they do spend money on new avenues. And that's what we've got with this company. They recently acquired Plush on the 1st of November. Plush had less than 50% of the margins at the EBIT line that Scully's have. We think that Scully's can take them to the same sort of level of margins that they experience in their core business. At the moment, they have 108 stores across Nick, Scully and Plush. We think that's going to 200 over the next decade. Believe it or not, when we entered COVID, they didn't have an online presence. They built one in April, and in the half just gone, delivered $8 million of EBIT on just $14 million of sales at a 58% EBIT margin. I'm just going to put that in context. Temple & Webster are striving for a 2 to 3% margin, right? These guys just delivered 58. We think they'll deliver $20 million of EBIT for the full year, making their online business, which is less than 10% of their overall business, more profitable than Temple & Webster, which have a higher market cap. I know which business I would be choosing to invest in. They're expanding into new categories. We think the world's their oyster for a business of this quality. It's run by founder Anthony Scully, owns more than 13% of the stock on issue, and we're very focused on founder-led businesses. My last example of something we've been buying recently is Homeco Daily Needs REIT. Again, we're attracted to its simplicity. They own 51 homemaker centres around the country, and homemaker centres have a very, very, very strong tenant base. And as a result, their occupancy is 99%, their cash collection is 99%. And have a look at the metrics for the company at the moment. They're yielding more than 6.5% at an asset level that's growing at 3.6% per annum. So if you're a tenant of theirs, your rent increases at 3.6% per annum. But that's not the exciting part. The exciting part is the next line. Their re-leasing spreads are running at 4.9. So you get to the end of your lease, and normally you would expect the start of the next lease to be 3.6% higher, and instead they say, no. We're having an additional jump. Okay, that's in stark contrast to what happens at, say, a Vicinity or a Scentre Group. Vicinity in the half just gone, their re-leasing spread was over -6%. So you give up the last couple of years' worth of rental increases to re-sign that exact tenant. That doesn't happen with these guys for the simple reason that their average rent per square metre is only $335. That contrasts to a Vicinity at over $900. So these are the most profitable stores for their tenants, and they're all the same sort of tenants. The only tenants they don't have that sit in those large shopping centres, they don't do fashion, they don't do food, right? So it's your electrical appliance retailers, it's your furniture retailers, it's your large goods retailers, and we're very, very excited that re-leasing spread, that positive re-leasing spread can continue for many, many years into the future. And I'll finish off on this analysis with the very last line. The other thing that's exciting about this stock is their site coverage is only 38%. 62% of their properties are vacant land. So they're going to be running 5 to 10 developments on properties that they own that are part of existing shopping centres or attached to existing shopping centres for probably the next 10 or 20 years. At the moment, that development pipeline of 500 million is more than 10% of their current asset base, which sits at just under $5 billion. So this is a business that we think will deliver a very attractive 11 to 12% total return, with the development additions on top of that and any other smart things that management can do incrementally positive. A very attractive total return for the risk that we think we're taking. So this is how we are positioned today. Our largest exposure is in the consumer discretionary space. That's the dark blue. for very obvious reasons. We think the consumer is in a very, very strong position, and we very much like a lot of our consumer discretionary positions. We are a very quality-focused manager, and I'm just going to give you one metric rather than explain this chart. Our one-year historic ROE, statutory, not made up, not pro forma, is 40.1%. Right? If you want to understand whether a manager is actually focused on buying quality businesses, ask them what their statutory historic ROE is across the portfolio. And the last point I'll make is we're very, very focused on shareholder-run businesses. And the reason for that is they take advantage of every opportunity, and we can give you countless examples where a founder goes and takes an advantage and opportunity. They're not thinking about their workload. They're not thinking about their tenure at the company. They're thinking about creating value for them and you as shareholders. And the second point is you tend to avoid all of these unnecessary conflicts of interests. They're not trying to make the earnings match their duration at the company. They're just focused on acting in your interests and their interests because you have complete alignment. So 3/4 of our portfolio are run by major shareholders.